All right, time to kick it off. So welcome. Thank you everyone for joining us today. This is our first, hopefully of many webinars for Emerge 360. The next one is at noon on October 13th, and we'll be covering 401k rollover planning options. So if you're switching jobs or retiring, that'll be a good one to attend. And then the next one is October 20th, which again starts at 6 p.m. And that one is specifically for financial planning. So if you're new to the workforce or near retirement, there will be some really good takeaways there, specifically regarding financial planning. So check your emails if you haven't registered for those and you're interested, and go ahead and sign up for those. Just a couple of quick things before we jump into the main topic for today. We are recording this session and we're hoping to send it out early next week, so you can review it if you'd like. And then secondly, we have a lot to cover tonight, so we will not be taking questions at the end. But if you do have something specific you want to ask us or chat with us about, we're happy to help kind of on an individual basis. So feel free to email us at info@emerge360.com if you have a specific question, or you can call us at 1-83-EMERGE-360, which is 1-83-EMERJ 360. Again, if you have a specific question, feel free to call or email and we can address it then. So today we're going to be covering Social Security planning and covering kind of some tips and tricks and different basics there. So before we begin, just want to do quick introductions. My name is Heather Jordan. I'm the Managing Director for TrustPoint's Emerge 360 division. I've been with TrustPoint for about 4 years now. Previously worked in our wealth management department, helping clients with IRAs, trust accounts, agency accounts, things like that. I'm also a CFP, or Certified Financial Planner. So I do all of the financial planning for our Emerge 360 clients, as well as several TrustPoint clients as well. And then Brett is also on the call, and I'll let him introduce himself.
Thanks, Heather. My name is Brett Sibian. I'm the financial coach at Emerge 360. Been at TrustPoint for about 4 years as well. Spent most of my time in the investment department before hopping on to the Emerge 360 team, where I do a lot of the education for our 401k plans and clients, and still kind of focus on the investment side of the relationship with individuals that we work with.
Brett will be mainly covering the next webinar on rollover planning, so feel free to join that one if you're interested, and he'll be covering that topic. So our agenda for our webinar today, we'll be talking about different Social Security misconceptions, things that we've heard from clients or other people, Social Security basics, when to begin benefits, taxability, retirement planning, and then different resources specifically for Social Security questions. All right, so some common misconceptions that we have heard from people, or they've come up in meetings. The first one is that Social Security is going broke. We hear this all the time from people. They maybe don't want to rely on Social Security, or they think they're not going to get any Social Security. We hear this from people who are 30, 40, 50, 60, kind of all over the board. People have a lot of questions and a lot of concerns about how long Social Security is exactly going to last. So without any changes, the Social Security Trust Fund is estimated to be depleted by 2034. However, Social Security is a pay-as-you-go system, and as such, will continue to collect revenue from payroll taxes. So even if Congress were to enact absolutely no changes, which is pretty much unlikely, based on incoming payroll tax collections, Social Security would still be able to pay an estimated 78% of benefits. Something that Congress may do in the future to kind of keep this system going is they may increase taxes. They may also raise the full retirement age of people collecting benefits. They may reduce benefits, things like that. So they're probably going to make a change. We're not sure what it is exactly, but it's a very common misconception that Social Security is going broke. There's still people paying into the system, so there still is money to be paid out to people who are retiring. The second one is that the full retirement age, also known as FRA, if you've ever seen that anywhere, is 65 for everyone. So that is very common misconception. It actually depends on your year of birth and varies from ages 65 to 67, again, depending on what year you were born. I think people commonly would say, retirement is age 65. That depends on your full retirement age. And another thing I want to point out with this is that just because something is your full retirement age doesn't mean you have to work until that age. I hear a lot of clients say, my full retirement age is 67, so I have to work until 67, and then I'll collect Social Security. There's many different strategies that you can do and kind of pros and cons to different things, but it's not the age you have to work until, it's the age that you would receive your full retirement benefit. Next is that Social Security will replace most of retirees' income needs. This is not the case. So the program was never intended to be the sole source of income for retirees. As a general rule of thumb, Social Security will replace about 40% of pre-retirement income for an individual with average lifetime earnings, though the replacement ratio is far lower for individuals with high lifetime earnings. So you may have heard of, kind of a three-legged stool for retirement planning. It's kind of a term people used a while back. That means that your income for retirement is from Social Security, pensions, and then savings and investments. So it was never designed to provide 100% of your income in retirement, only about 40%. If you're someone who was a pretty high earner throughout your lifetime, it's going to replace less of your income because it's not unlimited. There is a cap on how much you can draw from Social Security or how much you'll receive from Social Security. So keep that in mind as you're working on your financial plan. And then lastly, earned income is not allowed while collecting Social Security benefits. That is a pretty big misconception with a lot of people. Individuals can continue to work after receiving Social Security benefits. If an individual collects benefits before full retirement age and has income which exceeds the earnings limit, then a portion will be reduced. So we'll talk about this a little bit later, but there is a certain amount that you can earn without affecting your Social Security benefits. Once you reach full retirement age, which again is different for everyone based on when you were born, you can earn as much as you want. So we have a lot of clients who go back to work after they reach their full retirement age, collect the benefit, kind of double dip, they have an income, and they're also earning Social Security. So next, on to Social Security basics. Before I jump into what benefits are, how they work, things like that, I thought I would just cover some basic terminology and things that people get confused when they're talking specifically about Social Security. So what we're talking about today is Social Security, otherwise known as retirement benefits. That is different from SSDI and SSI. Those are for people who have disabilities, and it's either needs-based or work-based income specifically for those individuals. If you have specific questions on SSDI or SSI, I would refer you to the Social Security website to learn a little bit more about those. But today we're talking about specifically Social Security and what retirement benefits are. So how do benefits work? Social Security replaces a percentage of your pre-retirement income based on your lifetime earnings. The portion of your pre-retirement wages that Social Security replaces is based on your highest 35 years of earnings and varies depending on how much you earn and when you choose to start benefits. So when you work, you'll see a line item on your pay stub that says paying taxes into Social Security. That money is used for people who have already retired, people who are disabled, survivors of workers who have died, and dependents of beneficiaries. So your payroll deductions are not going into a specific account for you. So for example, my payroll deductions don't go into an account for Heather Jordan. They go into a general fund to pay benefits for this group of people. One of the reasons that people sometimes have the misconception that Social Security is going away is because there's so many baby boomers who are retiring, people leaving the workforce. They are collecting Social Security more than ever before just because there's so many of them, and there's less workers entering the workforce. But there will always be people who are working, contributing to the Social Security system. So it's highly unlikely that that fund will completely run dry with no solution. There's probably going to be something that's solved for that. The other thing I want to mention on this is that the Social Security earnings limit is $147,000 for 2022. So if you make more than $147,000, you're not paying Social Security tax on anything in addition to that. It's just up to $147,000. Next question I want to cover is who's eligible for Social Security. So when you work and pay Social Security taxes, you earn what's called credits towards Social Security benefits. The number of credits you need to get retirement benefits depends on when you were born. So I'm going to make the assumption that most, if not everyone on this call, was born after 1929. And if that's the case, you need to earn 40 credits, which is usually 10 years of work to qualify for Social Security retirement benefits. If you stop working before you have enough credits to qualify for benefits, the credits will remain on your record. If you return to work later, more credits may be added. So if you never kind of collect these 40 credits, you cannot collect any retirement benefits. The other point I want to make on this slide is that you can apply for benefits no more than 4 months in advance of your benefit start date. So it's really important to plan ahead because this isn't instantaneous. You can't say, I'm going to apply for Social Security and I'm going to get a check tomorrow. There is a little bit of a process to go through. So be thinking about this ahead of time. So if you want to take benefits at age 65, apply for those 3 or 4 months ahead of time. If you're wondering what one credit consists of, so one credit specifically for 2022 is $1,510 in earnings. And then 4 credits is $6,040. So if you're earning that each year, you're likely racking up these credits to apply towards your 40 credit goal. So how much will you receive? That's a question we get from everyone. The answer is it depends. It depends on your earnings, the years of earnings, your average earnings, and the timing of claiming your benefits. Just kind of a fun fact, if you're curious, the average benefit that a retiree receives is $1,657 per month. Again, depends on many different things, but that's the average benefit that's paid out. The maximum that someone could receive is $4,194 a month. And that would be if they, had maximum earnings for these 35, 40 years, they have all of their credits. And then they're also delaying taking their benefit until age 70. We'll talk about it a little bit later, but there are different benefits to delaying Social Security past your full retirement age. And then there's different pros and cons for taking it prior to your full retirement age. I thought this was a pretty interesting chart to show the cost of living adjustment or inflation adjustment specifically for Social Security. So many of you probably noticed last year that it went up significantly. It went up 5.9%. This is not common. As you can see in many of the previous years, it's around 1%, 2%. Some years it didn't go up at all, so it stayed consistent throughout the years. If you look way back to the 1980s, you'll see super high inflation rates or cost of living adjustments for Social Security because inflation was so high around that time. So I would not expect this number to continue indefinitely going forward. When we do financial planning for clients At TrustPoint and Emerge 360, we use an inflation rate or cost of living adjustment of 1%. We like to be more conservative and not say your assets or Social Security is going to grow at 6% annually if that's not a consistent number. But it's pretty interesting to see going back, that was the highest increase since the 1980s, but typically it's around 1 or 2% annually. If you're someone who's already receiving Social Security, you will get a letter in the mail that says, here's your current benefit, here's the cost of living adjustment, and here is what your benefit will be for the next year. So you'll be notified of what that changes. So when do benefits begin? Benefits can begin anytime between ages 62 and 70. You must be at least age 62 for the entire month to be eligible to receive benefits. If you were born on the first or second day of the month, you meet this requirement in the month of your 62nd birthday. If you were born on any other day of the month, you do not meet this requirement until the following month. Like I mentioned before, you can apply up to 4 months before you want your retirement benefits to start. So again, very important. It can't happen overnight. So be thinking ahead. If you want to start at 64, 65, 66, apply about 4 months before you want to collect those funds. So in this example, if you turn 62 on December 2nd, you can start your benefits as early as December and apply in August. Even if you're not ready to retire, you should still sign up for Medicare 3 months before your 65th birthday. So Medicare is different from Social Security. Medicare is specifically healthcare in retirement. So that's very, very important, and everyone should sign up for that. And that starts when you're 65, not your Social Security full retirement age. So those were kind of the basics, what Social Security is, how it's funded, things like that. We're going to talk next about when to begin benefits and what makes sense for you. So choosing when to begin benefits, there's several key factors that come into play when we're doing financial planning with clients and things that we discuss and determining what makes the most sense for them. So it depends on your life expectancy, income needs, spousal benefits, and changes in employment. So if you are someone who is no longer working and you're struggling to pay your bills, either because you don't have enough in your investments or savings, or you don't have any savings, it's probably better to consider applying for benefits earlier rather than later. If you're someone who's in poor health, it's probably better to consider applying for benefits earlier rather than later. You want to get the most bang for your buck. If you have a shorter life expectancy, you'll want to apply sooner so that you can start receiving those funds throughout your lifetime. And then also, if you are the lower earning spouse and your higher earning spouse can wait to file, it might be a good idea to consider taking benefits earlier. If you are someone who's still working, and you make enough to impact the taxability of your benefits, you might want to delay taking your benefits until later. We'll go over the specific earnings amounts in a couple slides, but if you're working, you have an income, you don't need to take Social Security, it would be in your benefit to kind of delay that and take it later on and just live off of your income and your investments. If you're in good health and expect to have an average or exceed the average life expectancy, you'll want to take it later because that's going to be the highest benefit for you. And then lastly, if you're the higher earning spouse and want to be sure your surviving spouse receives the highest possible benefit, consider taking benefits later. So this chart shows full retirement ages for all of these birth years. So like we talked about before, 65 is not the retirement age for everyone. It's actually just for people born 1937 or earlier. So if you look at the year you were born, let's just say 1958, your full retirement age is 66 and 8 months. Again, this is not the age you have to work until. It's just the age that you get 100% of your Social Security retirement benefits. If you elect to take Social Security prior to your full retirement age, so using this same year as an example, if you want to take Social Security at age 65 instead of 66 and 8 months, there is a permanent penalty on what you'll be able to receive monthly. So for the first 36 months, the full retirement benefit is reduced by 0.5% for each month before full retirement age. Beyond the 36 months, the full retirement age benefit is further reduced by 0.5% for each month early. So you can see there's different pros and cons for taking it early, maybe delaying it, but this is a permanent reduction if you take it early. So it's really important to have a financial plan in place and make sure you have all of your ducks in a row and not just electing a time to take Social Security. It's important to plan for that and make sure everything is aligned. The plus side is if you decide to take Social Security after your full retirement age, there's a permanent increase in what you'll be getting. So if you were born after 1943 or later, every year beyond your full retirement age that you delay Social Security, it's going to grow by 8%. And I have a really nice chart here that shows what that could look like. So I'll talk through this because it's a little bit confusing. So 100% benefit, this would be if you took your Social Security retirement benefits at your full retirement age. So you get 100% of your benefits, whatever age that is for you based on your year of birth. If you delay taking Social Security by 1 year, it's going to increase to 108%. If you delay it by 2 years, 116%, 3 years, 124%. And that's a permanent increase in your benefits. If you, on the flip side, decide to take it prior to your full retirement age, you can see the permanent decrease here. So if you take it 1 year prior to your age, you'll get 93.3% of your benefits. And that's every year. That's never going to increase. You take it 2 years, 3 years, 4 years, 5 years, you can see there's a permanent decrease in your benefits. These percentages we already kind of talked about before, but if you forget all of this, it is on the Social Security website, and you'll be able to see if I take it earlier or later, how will my benefit be affected? Another common question we get from people is, what's the average time to claim benefits? So there's actually been studies done that the average, or most people take it too early. This example shows that 41% of people take it at age 62, which is no one's full retirement age. Everyone would be older than that. And then the next most popular one is 22% of people take it at age 66. So we talk about this a lot in financial planning, but oftentimes people either underestimate how long they'll be living. So they think I'm not going to live very long, so I'm going to take Social Security early. And it turns out they live longer than expected, and it would have been better had they waited. They maybe don't realize that there's a permanent decrease in the benefit. They may just want to take Social Security right away, but there are different pros and cons to consider. And they may be more likely to have things taxed if they are still working. So this isn't when you should claim benefits. This is just the average, but it's different for everyone's situation. So evaluating a break-even age, this is an example of someone, you can see what their monthly benefit would be for age 62, 67, and age 70. I won't go through this full example, but there are different strategies, things out there that can help with this in determining if you live until age 76, 78, or 80, what's the best time to start taking Social Security. And I will actually show you what we use at Emerge 360 and one of the tools that we have specifically relating to Social Security. So this is not an actual client, so don't worry, I'm not sharing anyone's personal information, but this is a sample client for Tim and Susan Smith. When we go through a financial plan with someone, we have this tool available and it's specific to that person's situation. So it takes their actual Social Security benefit, what it would be at age 62, 66, 67, 70, so forth, all of those different ages, and we can see what makes the most sense for them and what makes their plan the most successful. So we can see if they take Social Security as soon as possible, what would their lifetime benefit be? Or if they waited until age 70, which is the most you can delay it, what would their total lifetime benefit be? And you can see the differences here. We are able to pull a kind of a break-even point, like you saw on the previous slide, of you have to live until this age to make it make sense for you. So we can have all of these conversations. This would be specific to an individual or a couple, and it's not just general numbers, it is specific to each financial plan. So next I'm going to cover earnings and taxes, which is a big question for a lot of people. So like I said before, there are different earnings limits based on if you're full retirement age or not. So I'll go through this kind of slowly, but again, if you go to the Social Security website, you'll be able to type in how much can I earn without it affecting my benefits, and you'll be able to get some of these figures. So earned income before your full retirement age for retirees collecting Social Security benefits before full retirement age, Social Security will take back $1 of benefits for every $2 over their earnings limit. Every year, the earnings limit changes. For 2022, it's $19,560. So if you collect Social Security before your full retirement age, you can earn up to $19,560 before your Social Security amount is affected. If you earn more than that, they're going to take back 50% of what they would have given you. So for income earned during the year that you reach full retirement age, so during the year you reach full retirement age and up to the month you reach full retirement age, Social Security will deduct $1 of every benefits for every $3 over the limit. So this changes in the year that you reach your full retirement age. The special consideration with this is that Social Security only counts earnings that you receive before the month you reach full retirement age. So for 2022, you can see this number is way higher. It's $51,960. So in the year you turn your full retirement age, let's just say it's 67, for example, you can earn up to $51,960 before you turn that age, and it will not affect your Social Security benefits. Once you've reached your full retirement age, there is no earnings limit, and you can still collect your full Social Security benefit. So again, if your full retirement age is 67, you collect that benefit, you can go back to work and earn as much as you want, and nothing will be held back from your Social Security benefit. We get a lot of questions from people on what part of Social Security is taxable. For some people, it's 0%, some up to 50%, some up to 85%. If you just Google how much of my Social Security will be taxable, the Social Security website actually has a calculator that you can use, which is really nice. And you can put in all of your own information and it'll tell you exactly how much will be taxed. So if you're in this situation, I highly recommend kind of filling out that calculator and seeing what it is for your specific situation. So another question we get from people is spousal benefits and family benefits. I won't go through each of these, but a couple of the popular ones we get questions on are spousal benefits and ex-spouse benefits. So picking on the easy one first, the ex-spouse benefits, you may be entitled to benefits from your ex-spouse's record if you meet all of these qualifications. So if your marriage lasted 10 consecutive years, at least 10 years, you have not remarried, and you and your ex-spouse are at least age 62. This does not affect any of the benefits that the ex-spouse will receive. For spousal benefits, there are a couple of different rules here. If you start between the spouse's age 62 and full retirement age, there's a permanent reduction in the monthly benefit and the earnings test comes into play. If you start after your spouse's full retirement age, you receive the greater of 50% of your monthly benefits or your spouse's full retirement age personal monthly benefit with delayed credit. So this is kind of confusing to people. Again, if you go to the website and create an account, you'll be able to put in all of your information and see what the maximum benefit is that you can get and when the time is to take that. So I wanted to throw in a couple slides specifically for retirement planning, knowing that Social Security is just one aspect of people's income in retirement. So we show this at a lot of our education sessions. So many of you have probably already seen this, but this is how much you should have saved at different ages to comfortably retire at age 67. You should need about 6 to 8 times your salary saved specifically for retirement. Again, Social Security is only going to be about 40% of your income replacement. So you have to draw upon your assets for the rest of your needs. So this chart is really nice to make sure you're on track. And if you're not, it's a really good time to do catch-up contributions to different accounts, maybe max out accounts, or if you're interested, set up either an IRA or an individual or joint account. Next is things that you can control in retirement. There's things that you can control and things that you cannot control. Things that you can't control, obviously market returns, tax policy, healthcare costs, things like that. Things that you are able to control include your spending, both pre-retirement and in retirement, and how you're allocated. So just kind of think of these things if you're getting close to retirement. Some things are out of your control, and try to really focus on the things that you can control and make sure that your budget, your goals, your vision for retirement, all of that is aligned. So how much do you need? So people typically need 70 to 85% of their income replacement ratio, specifically for retirement. To get to this point, the industry recommends saving between 10 and 15% annually, and that includes anything you contribute and anything your employer contributes. So if you're close to retirement and you're thinking, man, I don't have enough saved specifically for retirement, again, bump up those contributions, max out accounts, and now would probably be a good time to complete a financial plan to figure out specifically when you'll be drawing Social Security. The other thing that people oftentimes forget about is the cost of healthcare. So the latest figure is $300,000, which is the estimated dollar amount needed for an average retired couple to pay for medical expenses through retirement. So Social Security isn't going to cover this amount for everyone. So again, this should just be part of your plan, but it's still important to save your own money for retirement. And lastly, I want to touch on some different resources. So this was a lot of information and just wanted to talk high level Social Security and give you the basics. If you have more specific questions, I would recommend going to the Social Security website. You can actually create an account for yourself and your spouse and put in your own earnings history, your own information, and it'll give you an estimate of what your benefits will be if you take them early, full retirement age, or delay them until age 70. So I highly recommend if you're, 5-10 years from retirement, you use this tool, or even retiring next year or already retired, feel free to create an account and go on there and check out all of that. And that will be specific to you if you fill in your information. We also have some resources on both the TrustPoint website and the Emerge 360 website. So if you search Social Security on the TrustPoint site or retirement on the Emerge 360 site, you'll have different articles, videos, things like that. that you're able to review. And then if you scan this schedule a meeting with us, you'll be able to schedule a meeting with us and we can talk about financial planning, investment management, kind of answer any questions that you have. And then lastly, just wanted to have a slide in here on how we can help. If this was all interesting to you and you want to learn more, maybe get more into specifics about your specific plan, Emerge 360, again, is a division of TrustPoint, and we focus on relationships 50,000 and up. We have ongoing financial planning with myself, again, a CFP, to do that initial plan, and then any follow-up plans or questions that you have, we are available. We have a dedicated team and then enhanced technology. So feel free to check out our website or schedule a meeting with us if you want to learn more or have any specific questions. So thank you everyone for joining us tonight. I think I kept us within the 45 minutes, which is great. If you want to learn more, again, feel free to schedule a meeting, call us, email us. We're happy to help. Again, our website is www.emerge360.com, and it's spelled EMERJ360.com. Feel free to check out our Learning Lab. We have different articles, videos, different topics, different questions you can have answered there as well. We also invite you to follow us on social media. We're there, so like our stuff, share our stuff. It's really good information on different financial planning, market-related topics, so feel free to check that out. And then again, feel free to sign up for those other 2 webinars, which complete our October webinar series. We have the rollover planning and then financial planning, which are really good topics, and I think really timely for your end. So thank you for your time, and we appreciate you joining us.